What if I told you that the British economy is a house of cards, teetering on the edge of stagnation, with a government so untrusted it has to pay more for its loans than almost any other major nation on Earth? You'd probably assume its stock market is in the gutter, a reflection of the country's dire straits, but you would be profoundly, shockingly wrong. In one of the most baffling paradoxes of modern finance, London's stock market, the legendary FTSE 100, has been smashing records, hitting all-time highs in a blaze of glory. How is this even possible? The answer reveals a stunning truth about who really controls the United Kingdom's economic destiny. And here's a spoiler, it isn't the British people. In fact, it's not even close. Today, we are peeling back the layers of this extraordinary financial mystery.
We are going to explore a bizarre world where a nation's failing economy simply doesn't matter, where its own government's policies are casually ignored by the market's biggest players, and where billions upon billions of pounds are pouring in from overseas, propping up a market that seems completely detached from the reality on the ground.
In this deep dive, you are going to discover the surprising identity of the investors who now own the majority of the UK's biggest companies and why they hold a staggering 60% or even more of the entire market. We will also investigate the dangerous high wire act the UK government is performing, a performance that is alienating the very investors it desperately needs to fund its operations, costing the country an absolute fortune in the process. And finally, we will expose the ticking time bomb located across the Atlantic, a looming threat from the United States that could bring this entire glittering facade crashing down in an instant. This is a story of greed, fear, and the strange, often unsettling, globalized nature of modern wealth. So let's begin with the most fundamental question. Who is actually buying all these British stocks? The latest figures from the Office for National Statistics are jaw-dropping. As of the end of 2022, foreign investors owned at least 58% of the London market. And since that proportion was on a clear upward trend, it is highly likely that today that number has sailed past 60%. So who are these mysterious overseas puppet masters? They aren't shadowy figures from a spy novel. They are some of the biggest, most powerful financial institutions on the planet. Think of the colossal American asset managers like BlackRock and Vanguard, who manage trillions of dollars on behalf of millions of clients. Think of sovereign wealth funds from Norway or the Middle East, investing their nation's oil wealth. Think of Canadian and Australian pension funds seeking stable returns for their retirees. This isn't a new phenomenon, but it has accelerated dramatically since the Big Bang of the 1980s, which deregulated the City of London and threw its doors wide open to global capital. The result is a market that dances to a global tune, not a local one. The majority of the UK's flagship public companies, the crown jewels of British industry, are not owned by British pension funds, British savers, or British citizens. They are owned by international funds, foreign billionaires, and overseas corporations. Now, this is where the paradox begins to make sense. Why would these foreign investors pour money into a country whose economy has been shrinking? The simple, brutal answer is that they are not investing in the United Kingdom's economy. They are investing in global corporations that just happen to be listed on the London Stock Exchange. Roughly 3/4, a full 75%, of all profits made by the companies in the FTSE 100 index come from their operations overseas. Let's make this concrete. When you buy into the FTSE 100, you're not just buying a piece of Britain. You're buying a stake in Glencore's copper mines in Chile and cobalt operations in the Congo. You're buying into Unilever's vast network selling soap and ice cream to billions in India, Indonesia, and Brazil. You're getting a slice of pharmaceutical giant AstraZeneca's profits from cutting-edge cancer drugs sold across America and Europe. Or consider HSBC, a bank whose very name, the Hong Kong and Shanghai Banking Corporation, tells you where its heart and its profits truly lie, in the booming markets of Asia. The performance of the British economy is, for these behemoths, a secondary concern at best. The fact that the UK economy has been stagnating for a couple of months is, to them, little more than a rounding error. What the Chancellor of the Exchequer, Rachel Reeves, says about pension reforms or changes to savings accounts like ISAs is utterly irrelevant to a fund manager sitting in New York, Singapore, or Dubai. They don't use those products. And what she does about taxes in the autumn? It doesn't matter either, because they don't pay them. They are playing a completely different game on a global chessboard, and for now, the UK is just a convenient and very profitable square on the board. This creates a deeply schizophrenic reality for the UK's financial reputation. On one hand, you have this roaring stock market, the FTSE, which looks like a picture of health. But on the other hand, you have the market for the UK's own government debt, known as gilts. And that market is telling a very different and very frightening story. This is where we must ask the brutal question that finance ministers dread. Why does the United Kingdom have to pay more to finance its national debt than any other major developed economy in the world? The answer, I'm afraid, is a savage vote of no confidence. This lack of trust is not just a feeling. It's written in cold, hard numbers. The UK's national debt has ballooned to over £2.7 trillion. The government is borrowing billions more each month just to keep the lights on. International investors, the very same ones buying up UK company shares, simply do not trust the British government to get its fiscal house in order. They look at the UK's massive deficit and see a financial situation that, in the words of the UK's own official watchdog, the Office for Budget Responsibility, is simply unsustainable. That is a word that sends shivers down the spine of any responsible economist. It means that without drastic changes, the country is on a path to a sovereign debt crisis. When investors lose trust, they demand a higher interest rate to compensate for the perceived risk. That's why the yield on the 10-year UK government bond recently pushed up towards a dangerously high 4.65%. Compare that to Germany's borrowing cost, which is significantly lower. Investors demand a risk premium to lend to the UK, a surcharge for what they perceive as political instability and fiscal incompetence. This is a quiet but devastating indictment of the country's management. Every tick upwards on that yield means the government, and by extension the UK taxpayer, has to pay billions more in interest payments, money that could have been spent on hospitals, schools, or infrastructure. This is a pretty shocking disconnect, isn't it? A country whose companies are beloved, but whose government is distrusted. If you're finding this breakdown insightful, do me a favor and hit that like button to let us know. It really helps us understand what topics you find most compelling. So, given the government's perceived untrustworthiness, what is the irresistible lure of its companies? Why is the FTSE such a hot ticket? The first reason is simple: value. Even after its recent surge, the FTSE 100 is still considered cheap compared to its international peers, like the S&P 500 in America. Let's talk about that value. A common way to measure if a stock is cheap or expensive is the price-to-earnings, or PE, ratio. It's simply the share price divided by the company's annual profit per share. A high PE suggests investors expect high future growth, while a low PE suggests the opposite. The S&P 500 in America trades at a very high PE ratio, reflecting immense optimism, particularly in tech stocks. The FTSE 100, by contrast, has a much lower PE ratio. To a global investor, this looks like a bargain bin full of high-quality goods. It's up by more than 8% this year, which is a solid return. But the real headline act is the dividend yield. A dividend is a portion of a company's profits paid out to its shareholders, a direct cash return on your investment. The dividend yield on the FTSE 100 is currently a handsome 3.5%. That might not sound like a huge number, but compare it to the S&P 500 in the US, which offers a paltry 1.25%. For a large institutional investor managing billions, that difference is colossal. For a sovereign wealth fund investing £10 billion, that's £350 million of pure cash flow every single year. Furthermore, even where dividend growth has stalled, many of these companies have been engaging in massive share buyback programs. This is where a company uses its profits to buy its own shares off the market, reducing the total number available.
Critics argue they're a form of financial engineering that boosts executive bonuses and shareholder returns in the short term, but starves companies of cash for long-term research and development. For the foreign investor, however, it's just another mechanism that pushes their investment's value upwards. It's a perfect combination: good value, a high income stream, and a safety net propping up prices. But as with any party that seems too good to be true, you have to wonder when the music will stop. The coming weeks and months are likely to be incredibly volatile because there are huge risks looming on the horizon that the market seems to be blissfully ignoring.
The biggest of these risks is not coming from London, but from Washington, D.C. It's the threat of a full-blown trade war spearheaded by the United States and its overly self-confident president. We have become numb to the constant barrage of tariff threats, the chopping and changing of levels and timings. The markets have largely priced it in, assuming that common sense will prevail and some kind of deal will be struck. But what if it doesn't?
The historical precedent here is chilling. In 1930, the United States passed the Smoot-Hawley Tariff Act, which dramatically raised taxes on over 20,000 imported goods. The intention was to protect American jobs. The result was a catastrophe. Other countries immediately retaliated, global trade collapsed by more than half, and a painful recession morphed into the decade-long nightmare of the Great Depression. The worry is a 21st century repeat. A cycle of tit-for-tat tariffs between the US, China, and Europe could shatter the fragile global supply chains that our entire modern economy is built upon. The resulting inflation would be explosive, forcing central banks to raise interest rates into territory that would guarantee a deep and painful global recession. Beyond the mechanical risk of tariffs, there is an even more fragile element at play: confidence. Right now, there is still an incredible amount of money swishing around the global financial system, a direct legacy of central banks printing trillions of dollars, pounds, and euros during the pandemic. This ocean of cash is desperately looking for a return. We see evidence of this frantic search for yield everywhere, not least in the wild cryptocurrency boom, with assets like Bitcoin touching yet another all-time high. This isn't necessarily smart, strategic investment. A lot of it is just speculative froth. And the thing about froth, the thing about confidence, is that it can evaporate in an instant. As we have seen time and time again, from the dot-com bubble to the 2008 financial crisis, market sentiment can turn on a dime. And when it does, the exits get very crowded very quickly. We're about to bring all these threads together and give the final verdict on what this all means for the future of the market. If you enjoyed these kinds of deep dives into the hidden forces shaping our world, make sure you are subscribed and have notifications turned on so you never miss our next investigation. So, here we are, back at home, facing a grim reality. The government's finances are, by its own admission, on an unsustainable path. An increasingly desperate chancellor will almost certainly have to increase taxes this autumn, further choking an economy that is already struggling to grow. It's a bleak picture. This leads us to a profound and unsettling conclusion. We are living in an era of two Britons. There is the domestic Britain, the one experienced by its citizens, a country of stagnant wages, crumbling public services, and a government struggling with a crisis of credibility. And then there is UK plc, the corporate Britain listed on the stock exchange, a globalized entity that is, for all intents and purposes, a tenant in its own country, owned by landlords from all over the world. But look at the UK from the outside, through the eyes of that fund manager in New York. From their perspective, the domestic gloom is just background noise. They see a collection of world-class global companies. They see shares that offer genuine, tangible value. They see a decent dividend yield that provides a steady income, and they see tangible assets that offer some protection against the very inflation their own home countries are fighting. And that right there is the answer to the paradox. That is why the FTSE, against all domestic logic, hit its all-time high. It's a market for foreigners by foreigners. And as long as they continue to see value in Britain's global champions, they will keep it flying high, no matter how much the ground beneath it crumbles. The question is, how long can this divergence last? What happens when a country's main economic indicator
has no connection to the economic reality of its own people.
The sunlit uplands may be visible from the trading floors of London, but for many on the ground, the forecast remains stubbornly overcast.